Have you ever taken 3 losing trades in a row and noticed your 4th trade didn't feel like a normal trade? You weren't analyzing. You weren't planning. You were reaching for the next setup, reaching for the next entry, reaching for anything that would make the bleeding stop. You sized up, maybe just a little, maybe a lot. The trade went against you. And before you knew it, the day that started with a small drawdown had turned into the worst day of the month. That's tilt. And today we're going to break it apart piece by piece. Welcome back. This is episode 11 of the Perp Trading Psychology series. And this is the start of a new arc. The first arc covered the surface emotions of trading: FOMO, revenge trading, hopium, overconfidence, cutting winners, analysis paralysis, comparison, addiction, identity and ego. Each one of those is a discrete pattern. You can see it when it happens. But underneath all of them is a state of the nervous system that connects them. A state where the patterns activate more easily, more violently, and more frequently. That state is called tilt. Quick explanation for anyone hearing this term for the first time. Tilt is a borrowed word from poker. It originally described a player who had taken a bad beat and was now playing emotionally instead of mathematically. In trading, it means the same thing in a slightly different shape. A tilted trader is one whose nervous system has shifted from analytical mode into reactive mode. You're no longer choosing your trades. The trades are choosing themselves through you. You're not breaking your rules consciously. You're just not feeling them anymore. The chart doesn't look like data. It looks like an opponent. The position size doesn't feel like risk. It feels like an answer to a question your nervous system is asking. The question is, when do I stop hurting? And every trade you take in that state is an attempt to make the hurting stop. Let's start with the neuroscience. Because tilt is not a personality flaw. It's a measurable physiological state. When you take a meaningful loss, your brain releases stress hormones. Cortisol primarily, adrenaline secondarily. These hormones do exactly what they evolved to do. They prepare your body to fight or flee. The problem is, there's nothing to fight. There's no predator. There's just a chart. So the stress chemistry has nowhere to discharge. It sits in your system. It builds up across multiple losses. By the 3rd or 4th loss in a row, your prefrontal cortex, the part of your brain that does careful analysis, is partially offline. The amygdala, the part that handles threat response, is fully online. You're not stupid in this state. You're not weak. You're just running on a different operating system than the one you traded with this morning. That operating system is optimized for survival, not for risk management. There's a specific time signature to tilt that's worth knowing. Most traders go on tilt within 30 minutes of the triggering loss. The window from minute 0 to minute 30 is the most dangerous window in trading. In that window, the trader who just took a loss has a measurably higher chance of taking a worse one. Studies of professional poker players show this clearly. The 30-minute window after a bad beat correlates with measurably worse decision quality. The same is true for traders. The trade you take immediately after a meaningful loss statistically performs worse than your average trade, sometimes catastrophically worse. The pro knows this, so the pro creates a rule. After a meaningful loss, mandatory pause. The retail trader does the opposite. After a loss, they double down on screen time, trying to get it back. within that same 30-minute window. The window is the trap. The trap is invisible if you don't know it exists. There's a second mechanism worth understanding. Tilt is contagious across sessions. If you end one trading day on tilt, even if you don't take more trades that day, the residue carries into the next session. Your nervous system remembers. When you open the chart the next morning, you start that day already partially activated. You're more likely to take a setup that doesn't quite fit. More likely to size up to get back what was lost the day before. The losing day creates the losing week. The losing week creates the losing month. And most traders never trace the cascade back to that one trade 3 weeks ago that put them on tilt, and they never properly reset. The cascade is real. Most traders don't see it because they're inside it. Let me describe 3 specific behaviors that signal tilt. The first signal, the trade search compulsion. After a loss, you start scanning charts faster than usual, switching time frames, flipping between assets. You're not looking for a setup. You're looking for an exit from the feeling. A setup is something you have predefined criteria for. A trade search compulsion is something you do because sitting still feels intolerable. The pro on tilt notices this scanning behavior and stops trading. The retail trader on tilt takes the next mediocre setup and calls it conviction. The second signal, position sizing creep. After a loss, your normal position size starts to feel small. You tell yourself you need to make back the loss. So you bump up by 20%, then 50%, then double. The math doesn't support this. To make back a 10% drawdown, you only need a roughly 11% gain, which your normal sizing handles fine over a few good trades. But the math is not what's driving the sizing. The feeling is. The feeling says, I need this trade to fix everything. The trade has to be big enough to matter. And so the trade is sized for the feeling, not for the strategy. The third signal, strategy mixing. After a few losses, you start importing other people's setups. You take the trade your favorite Twitter account is talking about. You glance at a different time frame than your usual one. You read a thread and act on it before fully processing it. Your own strategy starts to blur with everyone else's. In your normal state, you trust your edge. On tilt, you don't trust anything, including yourself. The strategy mixing feels like adapting. It's actually disorientation. There's a cultural amplifier in crypto and perp trading specifically. The be a soldier attitude. There's a cultural narrative in trading communities that says, real traders trade through pain. Real traders don't take breaks. Real traders push through losing streaks. This is the worst possible advice for anyone on tilt. Pushing through tilt makes tilt worse. The chemistry of stress does not get processed by more stress. It gets processed by rest, by physical movement, by getting away from the trigger. But the cultural script says if you stop trading, you're soft. So the trader who needs a 30-minute break instead trades for the next 4 hours. By the end of those 4 hours, the original loss has tripled. The cultural script costs more accounts than any individual bad trade ever could. There's a leverage angle that makes tilt especially dangerous on perps. Leverage amplifies the cortisol response. A 10x leveraged 3% move feels emotionally like a 30% move on spot. So a single mid-sized loss on leverage produces a stress response that, on spot, would only happen after a much larger event. Translation: leverage traders go on tilt faster, harder, and from smaller triggers than spot traders. A perp trader can be fully tilted after one bad trade. A spot trader usually needs 3 or 4. This is one of the most important asymmetries in perp trading psychology. And almost nobody talks about it, because the leverage compresses the stress response. The recovery time also has to be longer. A perp trader who took a meaningful loss should probably stay out of the market for at least an hour. Not 30 minutes. An hour. That hour saves more accounts than any indicator ever will. There's a counterintuitive feature of tilt that traps even experienced traders: the fake clarity. When you're on tilt, the chart looks more obvious than usual. The next move feels predictable. The setup looks textbook. This is a hallucination. What's actually happening? Your prefrontal cortex has gone partially offline. The pattern matching parts of your brain are running unsupervised. When pattern matching runs without analytical supervision, every chart looks like a setup. The trader on tilt does not see fewer opportunities. They see more, and the trades feel more certain than usual. The conviction is louder. The doubt is muted. Pros recognize this fake clarity as one of the strongest tilt signals. If your trades suddenly feel obvious, like the market is finally cooperating, pause and check your recent P&L. If you've taken losses in the last hour, the obviousness is chemistry, not signal. Real edge does not become more obvious during stress. It becomes harder to see because the signal to noise ratio in your own perception has shifted. The trader who learns to distrust their own conviction during tilt periods protects themselves from one of the most expensive cognitive distortions in all of trading. The conviction is the trap, not the chart. There's a recurring after effect that traps people. The post-tilt shame spiral. You tilted. You blew through your daily loss limit. You took trades that broke your rules. The next morning, you wake up to the damage, and what happens then is critical. A healthy response is: review the day, write down what triggered the tilt, identify the rule that would have prevented it, and move forward. The shame spiral does the opposite. You replay the bad trades. You criticize yourself. You shame yourself. Then, and this is the key, you go back to trading the next day with that shame fueling your decisions. The shame is not motivation. The shame is residue. A shamed trader trades smaller for a day or two. Then, because they want to prove to themselves that they're back, they size up to demonstrate confidence. The size up is itself a tilt behavior, coming directly from the shame of the previous tilt episode. The cycle repeats, sometimes for weeks, sometimes for years, until the trader either learns to break the cycle deliberately or leaves the market. Most leave. So how do you train yourself out of tilt-driven trading? I'll give you 3 practical rules. 1. Define your tilt triggers in advance. Before you start trading, write down what counts as a tilt trigger for you specifically. 2 losses in a row, a single loss bigger than 2% of account, a losing day overall. The specifics matter less than the writing. When the trigger fires, you're done for the day. No negotiation. The rule has to exist in writing. Because once you're on tilt, your brain will rewrite the rule in real time to justify continuing. Written rules survive the emotional state. Mental rules don't. 2. Build a mandatory cool-down ritual. Decide in advance what you do after the trigger fires. Some traders close the platform and walk around the block. Some take a cold shower. Some lie down for 20 minutes. Some go to the gym. The specific activity matters less than the discipline of doing it. The activity must physically discharge the cortisol. Walking works. Lying motionless doesn't. This is not a luxury. It's the recovery step that allows tomorrow's session to start from a neutral baseline. Skip the cool down, and you start tomorrow already partially tilted. 3. Journal the tilt episode specifically. Not your trades, not your P&L, the episodes. When did you tilt? What triggered it? What you did? How you felt? What it cost? Most traders journal trades. Almost none journal tilt events. The trades are the surface. The tilt is the source. If you can see your tilt patterns in writing across 30 days, you start to recognize them in real time on day 31. Recognition is the beginning of choice. Without it, you're just being moved by chemistry. There's a flip side worth knowing. Professional traders treat tilt as a vital sign, not a moral failing. When a pro notices early signs of tilt, racing heart, scanning behavior, sizing pressure, they stop. Without judgment. They don't lecture themselves. They don't shame themselves. They just stop. The same way a marathon runner who feels a calf cramp stops to stretch rather than pushing through. Because the pro has internalized something most retail traders haven't. Tilt is not weakness. Tilt is data. It tells you the nervous system has exceeded its capacity for the day. That's information. Information that, used correctly, protects the account. Used incorrectly, it destroys the account. The pro uses it correctly. They stop trading. They recover. They come back tomorrow. The retail trader interprets the same signal as a personal failure to be muscled through. So they keep trading, and they pay for it. The mindset shift from tilt is weakness to tilt is information might be the single most important psychological reframe in this entire series. It's the difference between a trader who lasts 10 years and a trader who lasts 10 months. So to summarize today's episode, tilt is the nervous system state that connects every surface emotion in trading. FOMO, revenge trading, hopium, identity defense. They all activate more easily when you're on tilt. It's driven by cortisol and adrenaline after meaningful losses, with a 30-minute window of maximum vulnerability and a multi-day carry over effect into subsequent sessions. It shows up as trade, search compulsion, position sizing creep, and strategy mixing. It's culturally amplified by the "be a soldier" narrative that punishes traders for taking the breaks they need. It's structurally amplified by leverage, which compresses the stress chemistry and shortens the time to tilt by a meaningful margin. The 3 practical rules: define your triggers in advance, build a mandatory cool-down ritual, journal the tilt episodes themselves. Underneath all of it is the realization that tilt is a vital sign, not a flaw to overcome, a signal to respect. The trader who respects the signal trades for a decade. The trader who pushes through it usually doesn't make it past 2 years. In the next episode of this new arc, we're going to talk about something tilt eventually compounds into if you don't manage it. Drawdown survival. What happens to your psychology when you've been in the red for 3 months, 6 months, a year? The identity shifts, the capital protection mode, the depression spiral, and the patterns that separate traders who survive long drawdowns from traders who quit during them. If tilt is the short time frame of psychological pressure, drawdown is the long time frame. Appreciate you all for listening. If you found this episode useful, make sure to subscribe and share it with someone who keeps losing the day after a bad start. And I'll see you guys in Start trading now on Mosey Finance. Trade perps everywhere with one dashboard. Link in bio.